So the stats say younger generations have the highest uptake of self-managed super funds out of the whole population.
I'm surprised at those statistics. However, I'm also not, because I think people have a lack of sort of confidence in the institutions.
So who shouldn't look at a self-managed super fund?
To me, I would think you'd want to have a thought to buy either property directly or other suitable investments.
Welcome to the world of self-managed super funds. The statistics say that the younger generation are preferring to manage their own super rather than giving it to a big fund to do. But the question is, how do I do this? What do I use it for? What can I and what can't I do with it? I've invited Peter Collins from AFSG. He's an expert in this area, so we're going to pull this apart. If you're interested in self-managed super funds at all, you need to have a listen to this. How did you get into financial planning?
I always had an interest in it, but, you know, it takes you a while to find your lane. Took me a long while. took me till I was about 35.
Yeah.
Yeah.
Yeah. What did that look like? That's a great expression. It takes a while to find your lane.
Well, I'd always been in small business. Grew up on a farm. So, yeah, small business was what I was used to. Started off landscaping, lawn mowing to get through uni. And then that was successful, so I kept going. So my first degree was a teaching degree.
No way.
Yeah, phys ed teaching.
Huh.
Yeah. But I knew that wasn't the path for me. I loved the activity, but I didn't, enjoy the whole environment and the structure and the education system.
Yep. Fair enough.
Didn't seem to have any scope to expand beyond, being a teacher.
Yep. So what did you do next?
Went back to uni when I was 30. 6 years, part-time, at nights. And my first job was with a little boutique firm in West Perth, just for 6 months. And then I joined the CBA. 1 year there, and I was done.
I can tell how much you love the banking world.
I think it was 1 year and 5 days or something.
Who's counting?
It was sales, right?
Yeah.
So
yep.
I don't believe in sales. So that was the end of that. Then I joined another firm in Willetton, and he was a super salesman, but again, sales. So I don't believe you have to sell. You provide advice, and the clients like it, then they go ahead. They don't.
And that's your lane.
That's my lane.
Yeah. And you utilise that thinking in financial planning.
Yeah.
Yeah.
People just want an honest answer to something.
Well, that's why I like you so much, because even my clients will just ask you a question and you're happy to answer, and you'll provide advice at the right time, and you'll charge them for it, which is fair, but you won't charge them for stuff that you don't need.
But you don't have to be remunerated for it, right?
Yeah.
For everything.
Yeah, I love it. And that's why I wanted to talk to you about SMSFs. So the stats say that the younger generation, so people, we're talking sub 40, have the highest uptake of self-managed super funds out of the whole population. And the numbers are skewed the further you go back. So if they're under 35, I think 30 to 35 is probably the peak. But that means that the people in their late 20s are really thinking about it before they make the move. So it's a big topic.
Yeah.
The theme seems to be, and I can get this from my clients, that they'd rather have more control over their money rather than give it to a big fund. And I thought that's very interesting. It's very different from the era we grew up in. And I'm a fan of SMSFs if you know what to do with it, but that's why I thought this would be a great discussion to pull that apart and go, well, what is a self-managed super fund? What can you do? What can't you do? Because there's a whole bunch of what can't you do's in it. And maybe if you could share a couple of use cases where you've seen, you've got clients with SMSFs, how are they using them? And maybe a judgment from you, when should you, or who are the types of people who are better suited to it? Because some people I think aren't.
Yeah. Okay, so the first part is I'm surprised at those statistics. However, I'm also not, because I think you're right, people have a lack of sort of confidence in the institutions. However, at the end of the day, whether it's a self-managed super fund or it's a retail fund or it's a wrap retail product, it's not so much the house that matters, it's the furniture within. Mm. So if you have Australian super but you're in a conservative fund versus a high growth fund, then you will be worse off after 10 years. If you establish a self-managed super fund and you take a conservative approach with the investment part, then you will be worse off. On the flip side, if you take a ultra-aggressive alternative approach where there's lack of liquidity and all these other things, you'll also be worse off. Mm. So sometimes people don't know what they don't know. So I've seen self-managed super funds where they've just made a complete hash of it. Not because it's a self-managed super fund, but because they got the investment process wrong. So that would be the first concern I would have with those statistics. And I think people don't really understand that it's how they shuffle the investments and what risks they take versus the actual home that it lives in, be it self-managed super fund versus retail fund.
Yeah, that's a really good point. And maybe we should be starting with the principle of investment to start with and the mindset before we talk about, well, should you or shouldn't you?
Correct.
Yeah. Maybe let's talk about that for a minute. And I still want to talk about self-managed super funds because that's what we're here for. But we've got superannuation in Australia. If you're employed, you're going to get it. Mm-hmm. If you're self-employed, you're going to pay yourself some and, you can top up your contributions to a certain level. So in one way or another, you're going to have that as an investment. How do you choose where you put it and what sort of furniture you put into the fund?
I'll just comment that we have one of the best systems in the world as far as superannuation goes. But it's very important that people continue to educate themselves around risk versus return and handling volatility, because people call it risk, but it's volatility. So over a 10-year period, so time is the main ingredient, over a 10-year period, if you take a calculated higher level of risk, you will get a better return. If you also are consistent with your investment approach, you'll get a better return. So some people panic and then they make poor decisions, or they're inconsistent with how they invest. So they're really simple things that if you just go into an index fund, which is high growth, and you're consistent and you stay the course, you'll generally do way better than a conservative fund. Mm. It's very, very straightforward. But people there's not enough education about how that actually works. What is risk or what is volatility? How do you deal with it?
So can you give us a couple of bullet points on that?
So, for example, a measure of risk is standard deviation, right? So if you have like the ASX 300, it's going to run somewhere between 13 and 14 standard deviation. If you have a conservative fund, it's going to run between 5 and 6, okay? So as an example, in COVID, a conservative fund would have done maybe -1 for a 2-month period when we're in the... Whereas the ASX 300, I think, did somewhere between, and don't quote me on the exact numbers, but somewhere between -25 and -30 in 2 months. So everyone that was in conservative funds thought they were doing really well. The issue is if you'd been in a high growth fund and you switched out after 2 months and then went back to conservative, that was an even bigger mistake because you went from something which had experienced a lot of volatility and was just on the return back up because of the uncertainty to something that was full of bonds. So if you look at it now 5 years later, the conservative fund would have underperformed the ASX 300 by, it's probably done a fifth of the return.
Yeah. Pretty significant.
Significant. If you'd switched from high growth to conservative, you've done worse than that even because you missed all the recovery.
Yeah. Yeah.
So it's hard to educate people on, but we try hard.
I think the principle is relatively simple though, isn't it?
Yeah.
It's exactly what you said. This is a time play.
Yeah.
They're not short-term plays. You're not looking for a quick win. So it's a time play, and if you can accept that and go, in that period of time, things are going to go up, things are going to go down. But over the long term, the trend is to the right and upward.
And I can't control people's behaviour. I can only educate. That's our job.
Yep. Yeah.
As far as self-managed super funds, they are a good vehicle for the right purpose. So I have clients where, for example, they're tradies and they have bought their factory for all their business operations and they've housed it within a self-managed super fund. For them, it's perfect. So they love it. And I've got other clients that specifically wanted residential property. So they've instructed me to set up a self-managed super fund for that purpose. That's where it really works. If you're not going to buy direct property or other alternative or unlisted investments, then there's probably other options that are more suitable at a lower cost.
Yeah, because running a self-managed super fund comes at a price, doesn't it?
And a lot of responsibility.
How do we break this down to keep it simple? Let's talk about, what is a self-managed super fund?
It's essentially a trust.
Yep.
For the sole purpose of providing retirement benefits for the members.
Yep. And you control it as a trustee.
Yes.
Yep. And you're a member of the fund as you would be a member in a retail fund.
Correct.
Yep. So you've got the responsibility of forming an investment strategy and then investing the members' money, which happens to be your own, into various investment vehicles to achieve an outcome of some sort. That's the premise, isn't it?
Correct. According to all the regulations.
Yep. What can't you do?
There's a lot of things that you can't do. Specifically, the sole purpose test means that you have to act in the best interest of the members and there can't be any personal benefit. So therefore one thing you can't do is pull money out for your own use. Another thing you can't do is buy a residential property that you already own. There's a number of things that you can't do.
And you can't buy residential property that you're going to live in.
Correct.
Just because you've got super money.
You can't rent it to a related party. So there's a whole myriad of rules and they're all on the ATO website.
Let's say I've got a super fund and I'm going to buy a commercial property and you're my brother, can I rent it to you?
Yes.
So as long as it's a third-party lease, it's okay. Yep. And I can definitely rent it to a business that I own.
Yeah, as long as you don't enjoy a direct benefit.
Yep.
Has to be a commercial lease.
Yep.
Has to follow all the terms of commercial lease. Rent reviews, everything else. You can't have any benefit whatsoever.
So I can invest in crypto though, which I can't access through a retail fund.
You can.
Yep. Are there any rules around that?
No, again, but as a trustee, you have a responsibility to follow your investment strategy if that's part of the investment strategy that you choose to take, then invest responsibly.
So how do I actually go and set up a fund? How does that work?
Well, you can either do it yourself via various means where there's plenty of corporations that offer setup.
Yep.
Or you go to a financial advisor who can recommend that if it's suitable. Accountants can't recommend it, but they can provide advice on the structure, not on the investments. So they can instruct an accountant to set it up, but the accountant can't advise for them to set it up.
Yep. So very, very simply, it's a corporate trustee and a trust is the structure.
Generally, but not always. You don't have to have a corporate trustee.
Yeah, okay.
But if you've got more than one member, if you only have one member, you have to have a corporate trustee.
Yeah, okay.
If you've got two members, you can have individual trustees.
All right. So we've got the structure set up. There needs to be an investment strategy that's part of the Act, isn't it? Mm-hmm. Can I form up an investment strategy myself as an individual, or do I need financial advice to do it according to the Act?
No, the trustee has that responsibility.
Yep. Yeah, okay.
But they can ask someone to help them build that investment strategy.
Yep. And then the implementation you do yourself, of course.
Either
as a trustee.
Or through an advisor.
Yep. But you can have an advisor.
You can.
Yeah. So if let's say I'm 32 years old, I've managed to save a stack of money, I've got a fair superannuation balance, I own a business, and I'm thinking it'd be great to buy the warehouse into the super fund. And from a business person's point of view, I'd be thinking, well, my super fund owns it. I'm paying rent anyway, so why wouldn't I pay that to my super fund? The super fund will own it. There'll be some tax benefits later on, I hope, unless the government changes regulations, but I'm going to ask you about that in a second. But gee, I'm not sure about the rest of the investment strategy. Can I grab someone like yourself, a financial planner, to help me form up that investment strategy and manage those investments?
Sure, we do that all the time.
Yeah. So in that circumstance, when I own a business, I'm thinking to buy some property into it, and I want a mix of other investments because I'm thinking ahead, I can do it in conjunction with you.
Yeah.
Which would be great because I might not know much about investing in stocks, shares, crypto, whatever else is on the table, but I can lean on your expertise and get you to do that for me. And that won't get except the crypto.
Except the crypto.
Yeah.
We won't advise on that.
Yeah, okay. And that is actually a blanket thing across the industry, isn't it?
Well, most of it's not covered under PI insurance.
Yeah, okay.
So we have no cover for crypto.
Yep.
So therefore, it's completely out of scope. In fact, we'll put warnings around it, investing it, because if you provide a recommendation to set up a self-managed super fund, and then they go and invest in crypto, and then they lose all their money, then essentially you've recommended the structure for them to invest in crypto.
Yep.
So therefore, you're partially liable.
Yeah. Okay.
So we just put warnings. We do all around that. Yeah.
So what are the tax benefits of super generally? Because it'll apply equally, I'd imagine, to a self-managed super fund and a retail fund. So why would I do it? What's the benefit in investing in super?
Investing in super or a self-managed super fund?
In super generally, because even if let's say I'm employed by BHP, I'm on a decent salary, I can salary sacrifice up to a certain amount. I believe it's $30,000 a year now into my super if I want to.
Mm-hmm. Generally, you're generally going to pay a lower tax rate than any other either personal or other structures. So the only downside is that you need to meet a conditional release before you can access it. So if you're 30, you got a long time before you can touch those funds.
Mm.
If you're 63, then you don't have very long if you're still working, 2 years. So that's the trade-off. So you see more and more people after 50 thinking, I need to address this. So therefore they start to get serious about their super.
Yeah. Yep, that makes good sense. But if I'm 30 and I'm targeting younger people in this conversation because of the SMSF side, but if I speak generally for investment and super, it's a great idea to have some view to it when you're 30, isn't it? Because you've got the beauty of time for compounding.
It's a very good idea.
Yeah. So it's not a case of stick all your money in super because you need to live and there's other things that are going to come up and you can't access that cash. However, it is a wonderful vehicle for compounding where the tax rate's 15%, isn't it?
Yeah. On income, 10% on capital gains.
Yeah, okay. So it's a great vehicle. And when you get to 65, the money you take out of it is tax-free, isn't it? How does that work?
Well, the money is tax-free to the individual. If it goes to a non-financial dependent, then there can be tax applied. So like a 20-year-old son or daughter, for example. So you have to be careful about that. But going back to your last question, or if you're 30 and you're investing in super, then all your decisions around investing in super have to be completely suitable to your current situation. It may or may not be appropriate.
Yeah. And that's where a good financial planner with a good head on their shoulders might be handy for an opinion to say, well.
Because we all know that from 30, things start to probably get a little bit serious.
Yeah.
And you've got a lot of noise going on in your life. You've got starting a family, you've got mortgages, you've got everything is going on. It's a very busy time between 30 and 40.
Yep. I know when I was that age, super wasn't even on the radar.
For most people, it's not.
Yeah, I've got to live and we've got a family and we want to buy a house and that's far more important than thinking about super. Although little bits fed in, if I had better advice when I was younger, I probably would have done it. Because now I'm older, I would have had that time for compounding. So it would have really paid off, I think.
Might have missed a couple of holidays, but...
well.
Yeah.
I think for people in business, it's a great opportunity too, isn't it? Whether it's a self-managed fund or not, because you can contribute up to $30,000 and still, for the business, it's tax deductible.
Yeah, either the business or personally, whichever way they choose to do it.
So and it's personally tax deductible, is it?
Well, let's say you're an employee of a business and your salary is X and you're contributing $10,000 a year by super guarantee.
Yep.
Then there's $20,000 left in your cap, so you might make a personal contribution and claim a tax deduction for it.
Yeah, great way to do it. So
because there might be other participants in the business that mean you're not going to do higher contributions from the business necessarily. So you do it at any individual level.
So you can still take advantage of the cap, get more into your super and get a tax deduction for it.
You can either super guarantee, salary sacrifice, personal contributions. It's quite, there's a lot of availability to put more money in.
So who shouldn't look at a self-managed super fund?
That's a bit of a loaded question because it has to be specific. To me, I would think you'd want to have access or a thought to buy either property directly or other suitable investments that may not be available through a retail or industry super fund. Example, unlisted unit trusts that may not be available within a normal retail structure.
Yeah.
I've seen multiple things. You can buy art in there.
Yeah, okay.
Yeah. So that might be something that someone wants to do.
Yeah.
I've never actually seen it myself, but yeah, you can do that, but you can't have it hanging up in your house.
Oh, really?
No, because that's
for personal use.
correct.
Wow, I didn't realise that. So what do you do with it?
You can have other collectibles as well.
Yeah, okay. So you could buy
You could have a car.
Yeah, right. You can have a 1954 Mustang.
You cannot use it.
Yeah, but it's just got to sit somewhere.
It cannot be in your garage.
Yeah, right. That's weird. Interesting, but weird. Yeah. Right. So you can buy collectibles, although you can't advise on it. You can invest in crypto through it. You can buy property through it. Do all the normal investments you could do. And how about if I said
Everything has to satisfy the sole purpose test.
And what's the sole purpose test say?
Sole purpose test is too broad to just give specific details. So it's all detailed on the ATO website. Around
Roughly what's it about, roughly, if you were to summarise?
Basically, the biggest thing is no personal benefit.
Yeah, okay. So as long as there's no personal thing. So it's possible if you, me and John had self-managed super funds and we said we want to buy that commercial property over there, between the three of us, the three super funds could actually go and buy it.
Yep.
So there could be some advantages in doing stuff like that.
You can actually even purchase an existing commercial asset that you might own in another entity. So if you and depending on how you do it, you can get away with that transaction without paying stamp duty on the transfer.
Ah, how does that work?
You need to meet a number of rules around that, but it has been done.
Come on, Pete, give us the detail.
I can't give you specific details. So there was a commercial factory owned in a partnership, and that was transferred into a self-managed super fund with no stamps, nominal stamps.
Yep. I think there's something in the Stamp Duties Act that says, because I've seen it happen in property outside of super, where it says if it's something like a common ownership test, to say that if you have it in your name and it's yours and you're transferring to a trust, which is you're the only beneficiary, you're the appointor.
Same beneficiary.
Yeah, so you go, okay, well, it's actually the same person. We'll allow that transfer and no stamps will apply.
So we couldn't introduce another member in that scenario because that would have changed that test.
Yeah, okay. Yep.
So we didn't.
Yep.
But I refer that to legal.
Yeah, I think you always need legal opinions on these.
Yeah.
But I'm just saying, in the realm of possibility, what have we seen? Knowing that if anybody listening wants to test that, get advice. Yeah. Just don't take what we just said and go.
So you need multiple professionals in that area. You might be an accountant, lawyer, and financial planner.
And not for personal use. Make sure there's.
Well, no.
If it goes to
commercial, you can lease it.
Yeah. Okay. Yep.
Residential, no.
Yeah. All right. Good to know. What are some of the examples you've seen where self-managed super funds have been used really well?
In that case, it's been done really well. I've seen some example where it hasn't been done very well, whereby there might be family members and there is one controlling person in regard to investment strategy. And you try and get everyone involved, but that's not always the case. So therefore, the other members and their retirement assets are dependent on that controlling family member, which is not ideal. Everyone has to be involved.
So what happens in those circumstances? Say if I'm involved.
Sorry, not everyone has to be involved. Everyone should be involved.
If I'm a member of a fund with the family and I'm not happy with the investment strategy, I could exit, couldn't I?
Yes.
Or can I?
Yes, you can. You can roll out, yeah.
Yeah, so I can say, well, gee, Pete, I don't agree with that. I think I could do better.
However, if you have an illiquid investment, that might be difficult.
Yeah, so if we own property in that fund.
How do you then fund that rollover?
Yeah, shares are easy because I can sell the shares down.
Correct.
Yeah. How would I do it?
Well, that's why liquidity is so important. In one thing I learned at university was that if you can't get your money out, really consider why you're going to put your money into something. And if you don't have liquidity, then consider how much control you have. So if you own a property and you have full control, then you can decide what you're going to do with it. If you're part of a unit trust and you have no control, then you have no decision-making ability. So therefore your liquidity is limited and you may not be able to access the capital from that particular investment for 1, 5, 10 or more years.
Yeah. Yeah, that's right. Unless one of the other members wants to buy out my units.
Because you've got no control.
Yeah. Yeah. Yeah.
So I've seen that as well, whereby someone might have 10% of a external unit trust owned by their self-managed super fund, but they have no control. So therefore, I would like them to not be in that self-managed super fund because it's not suitable, but there's no way that they can exit. Especially when you need to fund your pension payments, you need more liquidity. So therefore, the whole thing becomes compromised.
So it actually does get very serious at the pointy end, doesn't it?
Yeah.
Because if you say, well, I'm going to call it a day now, I've got super, you need to be able to access it to pull money out.
Liquidity is one of the most important things that you should consider. If not the number one, it's top 5.
Yep. So this comes back to my thoughts around you need advice. Don't try and do it on yourself, by yourself, without having other people, other professionals have input into it, because it's all these things. It's a long game, and what you do today could affect what happens when you're 65 and you decide I'm pulling the pin off.
It can make a big impact.
Yeah.
As I said, your choice of furniture or whatever the investment assets is very important. That's more important than the structure, in my view.
Yeah. Yeah. Anything else you want to add, or any interesting stories you can tell us about it?
Well, the other thing is members will generally, in part of their investment strategy, they'll always have provision for insurance, personal insurance. So quite often people will set up self-managed super funds and then not consider the insurance, how it's owned, etc. So therefore, so you might leave a fund, roll over into a self-managed super fund, and then you forget completely about the insurance. You've rolled over your benefits, closed the other fund, and you've got no insurance. So then you're vulnerable.
Because the insurance, it happens automatically in a retail fund, doesn't it? Or does it?
You have to opt in these days.
Yeah, okay. Yeah. And then that's just paid through your...
But the amounts, some will offer a default amount, but generally it's up to the member to choose how much cover they want and what type of cover they want.
Yeah. Yeah. So you guys organise all of that if we were to come to you?
Yeah, well, you have to. Sometimes you'll have policies that can be transferred. The policy owners can be changed without a need to go through more medical underwriting.
Yeah, okay.
So that's important because if someone has medical issues, and that would restrict them from getting further insurance, then you have to be very careful that you transfer the existing insurance in its current format. You need to change the policy owner.
Yeah.
Life insured doesn't change, but the policy owner changes from whatever super trustee to the new self-managed super fund as the trustee.
Yeah. So when you dive into the detail, there are more complexities in these things than what you might consider on the surface, right?
Yeah, and there's a lot of administration that these things could get missed. So therefore, suddenly you then don't have any personal insurance. And then you have to go through underwriting again and apply for new policies, and then they pick up issues, and then you get health loadings or exclusions or whatever may be applied.
Yeah.
And then from that part there, you may be in a worse position.
Good point.
Your premium might go from X amount a year to double X.
Yeah, I've seen that happen with some of my clients, and they go, it's too much.
Or you can't get cover.
Yeah.
Yeah. So that's a really important thing.
And you can keep both open though, can't you? You can still keep your retail fund open and have an SMSF as
Correct, and that may be suitable because you might want to retain that cover
Yep.
in there or other benefits. So you can have multiple super funds. Is it efficient? It maybe not.
Yep.
Depends on everyone's circumstances.
So at a high level, if we were to say, look, there's benefits in investing long term, I guess that would apply, I reckon, whether you're in super or not. But think about your investment before you consider SMSF. But if you want more control and there's certain assets that you want to buy which you can't access through a retail fund, maybe SMSF is for you, but go and get some advice.
Correct.
That's pretty much it, isn't it?
Pretty much. You just got to make sure the suitability of that particular structure is for you.
Yep.
Or the other members that will be part of it.
So if people wanted that advice, where did they find you?
Well, again, I'll put a disclaimer in there that everything discussed today is general advice, and everyone has to take account of their own situation. However, I would direct clients to the Money Smart website. There's a whole list of advisors on there, and you can look at their qualifications. Never ever just rely on someone who says they're an advisor. You need to check it out.
That's good advice too.
So Money Smart website has it all.
Yep. All right.